Most people treat entity selections like a throwaway startup task. They file an LLC through LegalZoom and move on to what they love doing. But setting up your legal entity is not just legality, it's leverage. This is your blueprint to making money, to keeping money, to protecting your assets, and to scaling your business. This isn't about just filing forms, this is about strategy. So in the next few minutes, I'm going to show you how choosing the right business entity is going to help save you thousands in taxes, prevent you from legal disasters, and show you how to seriously grow your business. Let's start with the 5 foundational business structures you need to understand. Sole proprietorship. This is the easiest to start up, but there's no protection. You and the business are legally the same. So if you get sued or you go into debt, your personal assets are on the line. A partnership. It's similar to a sole prop, but with more members. So if you, so protection is low, just like a sole prop. So a partnership. It's like a sole prop with more members. Unless you form a limited partnership or a limited liability partnership, you're personally still exposed. And even worse is that if your partner makes a mistake, you're on the hook for that as well. Yikes. Limited liability company, or LLC. This gives you a form of protection. So your business is separate from your personal assets. And with the LLC, you can choose how you want to be taxed, whether that's as a sole proprietor, a partnership, an S corp, or a C corp. More on that in a second. S corporation. It's not a legal structure, it's a tax election. So as an S corp, you can, as a business owner, you can pay yourself a salary, and then the remaining distributions are not subject to self-employment tax. So if you're making 40 to 50K, this could be a game changer. So C Corp, this fully separates you from your business. It is completely standalone, but you're hit with double taxation. You are taxed at your flat 21% corporate income tax rate, and any dividends that you take as a business owner are subject to tax. But C Corp also unlocks things like deductions on employee fringe benefits, retained earnings planning, stock options, and even the potential to go public. So let's talk tax. So sole proprietorships are taxed on everything. Every single dollar you make is subject to self-employment tax. No separation, no shelter. So LLCs, by default, they mimic sole proprietor or partnership depending on how many members. But here's the strategy. If your business is making 40 to 50K in net profit, you can elect an S corp to save on the self-employment tax. So let me give you an example. If you're making 100K in your business and you take 50K as a salary, then the other 50K that you take as distributions is not subject to self-employment tax. Boom, this is like a $7,000 savings just from electing the S corp status. So C corps, they're taxed at a 21% flat rate and then again on dividends. But it has huge planning potential for retained earnings in the business, strategizing for long-term capital gains, deducting employee benefits, and offering equity incentives. Entity structure affects more than just your tax bill. It changes how you run your business. So running multiple ventures, use separate LLCs for each business and then form those under a parent company. This will protect each of your business from their individual liabilities, and it really makes your finances a lot cleaner. Hiring your kids or your spouse. If you're an LLC, you can pay your spouse or your kids a wage, and that's a business deduction. You can also set up retirement accounts for them. And you're teaching them real life money skills. I mean, me growing up as a kid, money wasn't something we talked about at the dinner table. And so I think that this is a great strategy to get kids to understand what they're going to be up against in the real world. So let's talk about C Corp long-term strategy. Use your retained earnings in the business to grow the business. Think about retirement plans you can offer your employees. And pay benefits that don't get taxed the same way. So entity selection isn't one and done. Your business should evolve. Here's when you reassess. Is your business making 40 to 50K in net profit? Are you starting to hire employees? Are you buying equipment or property? Are you considering a sale or a succession plan? Are you considering selling your business? Or have you entered into a new partnership or joint venture? Let me tell you, don't wait till tax season to figure this out. Here we are, we're already Q3, so between Q3 and Q4, you want to get with your tax advisor in case you have to pivot, you're not in a panic at the end of the year. So here's the bottom line. Your business structure isn't just a label, it's your tool, it's a weapon, it's strategy. The right entity choice is going to lower your tax bill, protect your assets, and help you scale. The wrong one, it's going to leave you paying more than you should to Uncle Sam. You're going to be exposed to lawsuits. So now what? If you haven't reviewed your legal structure in a year, do it now. If you're scaling or hiring or shifting, talk to a tax pro. And really, it takes about a 1-hour strategy session to help you save thousands in taxes. So please don't let the IRS or a lawsuit be the reason why you take this seriously. Build it smart, review it annually, and use it as a strategic advantage. If this helped you rethink your setup, hit the like button. If you feel like you need a more deep dive on LLCs or S Corps, book a call at the link below.